Well, the Nifty fell 1% in this financial year, underperforming its Asian peers. IT was one of the worst performing indices, losing 21%. That's in the financial year FY23, while PSU Bank Index gained for the third consecutive year. Well, we put to an end FY23. We begin a brand new fiscal starting tomorrow. So on this edition of the Editors Roundtable, we discuss the market setup as we head into a new fiscal. We also put the spotlight on a couple of sectors. There's the pharma companies that we're going to look at, and we're going to tell you all the big triggers to watch out for in the next fortnight. I'm Sonia. With me, I have the editors, Prashant, Nigel, Ekta. Folks, it's the last day of a truncated week, and another truncated week to come. That's amazing.
The way the excitement levels were zooming, it was always as if you're ending the calendar year 2020. Even in closing bell, it seemed like that, right? Because you were coming out of a holiday, you're going into a long weekend, and then there is next week. Nigel is...
Now, I've done the calculations, right? I told you all. If you calculate from yesterday onwards, you have 18 days. Out of the 18 days, 10 days you're shut. Yeah. So if you come only for 8 days, so stay well and come for those 8 days.
And the IPL
kicks off today.
Yeah.
Who are you going with?
Mumbai Indians, as always.
What about Dhoni? This evening he's playing.
Oh, yeah, he is.
I mean, that's the only...
so there's lots, right? There's truncated week coming up. There's IPL. There's salary payday, which has already come for us. But yeah,
Sonia's not aware because she's not debited the salary. It came a few days ago.
She was probably at the Dior show shopping.
I wish. But overall for the market as well, right? I mean, give and take everything. We've had a good run, and finally there's some respite for the bulls.
I mean, it looks like it, right? You can call it NAV management, and people were talking about that. But I think you finally are starting to see some room for relief rallies come through. We were actually talking about this tactical up move relief rally 3 weeks ago, and then this SVB bank thing happened, and everything went into a tailspin. But I think, those issues seem to be resolved. Not resolved, at least they are not festering anymore. They're in the background. And that's the reason why we are saying that perhaps, just perhaps, as we start the new FY, when we come back next week, there perhaps may be a little bit more to run. Let's just quickly run you through a very simple graphics will tell you where we stand really without going into too much detail. The Nifty has underperformed most global markets by quite a bit. These are all local currency term returns. Year to date, the Nifty is down 4% now. The S&P is up 5.5%. The Nasdaq, of course, is zooming 15%. And you got the largest, the European stock index, the benchmark there, which is up about 13% or so. I mean, looking at the screen, you would have thought that the problems are coming from India. I mean, it's not the case. The problems were from the West, but those markets are doing just fine. And that perhaps is a function of the huge outperformance that India saw last year as compared to most other global markets. Now, India also is extremely oversold. I looked at the latest EPFR data, right? At the margin, if this number starts to change a little bit, it may have a big impact. Remember, almost 95% of the foreign money that India gets is through global emerging market funds. And EPFR says that India remains the highest net sold emerging market year to date so far. That number is close to about negative $3 billion or so. Now come to valuations. Valuations have also, and we put this up a couple of weeks back, valuations have corrected. We spent 19 months with no returns. So that's a long period of time, and as a result of which earnings have caught up, and we are now at about 17.3 times FY24 earnings. The 10-year average is 17.6. So, by a sliver, you are slightly below. Mid-cap index, 1 year forward, that's FY24 valuations are 22.3 times. The 10-year average is 20.7, so you could say you're still a little more expensive. The small cap 1 year forward valuation is 16.4 times. The 10-year is 15.9 times. So it's not wildly overvalued, at least on the Nifty. You are now at fair value compared to the last 10-year average. Global markets have also become a little better this week, especially compared to the last 2 weeks were completely manic, and this week things seem to be settling down. And you can kind of look at all the headlines which are coming, but I think one data point which tells you more than anything whether things are settling down is how much are banks borrowing from the Fed's discount window. That's the big backstop. When banks are in trouble in the US, they go to the Fed and borrow, largely from the discount window. That number, week on week, has been coming down. The latest data for the week ended March 29th is on your screen, and from the peak of $153 billion 2 weeks ago, it now stands at $88 billion or so. The big unknown, global markets, of course, they're not festering, they're not making headlines, so quiet is all good. But the fact is, if US markets, as many believe, will face trouble at some point in time, that is the big unknown. And you can't do away with the fact that the correlation is pretty high. I mean, I looked at data since 2001, and monthly returns for emerging markets, the EM index and US, are correlated in the same direction 84% of the time. I mean, that is a pretty steep, significant correlation. So you want global markets also to do well. We're no longer in the 2021 market where, I mean, whichever way the world went, the market here will continue to do well. Earnings, of course, start next week, and I think we will take note of that. Remember, after third quarter, there were steep earnings downgrades for FY24. That is something that you want to see running in the opposite direction. At least some stability in earnings, commentary, etc., will go a long way in helping the market find a little bit of floor, Nigel. You've looked at the full year, Nigel, FY23, right? And